What's going on, everybody? It's Brian Tripp. Welcome back to another episode of the Real Estate Investing Live podcast, where we interview the very best real estate investors, entrepreneurs, and business leaders all throughout the country. And today I'm excited. I'm always excited, but today when I get to speak with a good friend and someone who really knows his stuff, that really gets me excited. And today, Chris Naugle is joining us, the money man, Chris Naugle. How's it going today, Chris?
It's going good, man. Thank you for having me on the show. It's a real honor and privilege. I know it took a while to kind of get this thing scheduled with our calendars, but really a privilege to be here.
Chris, I appreciate you for all you've done for Real Estate Investing Live over the years. You've come to Birmingham to speak. You've been on the show before, and we've had a lot of conversations and stuff. So I really want to dig into a topic that we've touched on in the past. But it's near and dear to your heart, and it's known as the infinite banking concept. And I know probably a lot of people who are watching this or listening to this have either heard of this, or maybe they understand it a little bit, but they may not be participating in it yet. And I just have to say right off the bat, Chris, as I watch some of your content that you've put out here within the, just in the last 3 to 6 months, I don't know of anyone personally who can explain this stuff like you do. You have just a gift, because this is a kind of a hard topic.
Yeah.
And you've really just have a way of helping people understand how to deal with money. And so I want to just let's just start right there. I want to just jump right in. What is infinite banking concept, and why should we be using this?
Yeah, thank you for that. And, I give a lot of credit recently to, my explanation of this is I look at everything from a father standpoint. You can relate to this. I have an 18-month-old, and my biggest goal in life now is to make sure that I teach her these principles and how these things work. So when I teach, I literally am teaching in the sense that, like, I have to help an 18-month-old, or, well, that's a joke, but, a 5-year-old be able to understand this. So what is the infinite banking concept? And a lot of people, when they hear the infinite banking concept in the different categories, they might think that it's a product. Oh, infinite banking concept is those stupid whole life policies. Absolutely incorrect. You couldn't be more far from the truth, because the infinite banking concept is not a product at all. It is a process. And that process involves something very simple. And that process is just taking back the banking functions in your life. Quite simply, we all have been taught to give up control of our money, take our money and put it in somebody else's bank. And then when we need money, we either save up money in another bank where the bank is actually benefiting you or not, or we borrow from the bank. And essentially, we're borrowing our money back at a multiple of 500 to 1,300% more than what we're making on our money there. So the simple idea of the infinite banking concept is, if banks do this, and banks can make 400 to 1,300% more than we do, why can't we take those banking functions back into our life? In other words, why can't we, instead of using a bank to finance a car or a copy machine or a boat, why can't we create a banking system and then basically loan money to ourselves for the things we buy, the things we drive, the things we own. And then instead of paying a bank, we just pay our bank back. And Brian, here's the best way I can explain this. And it's a series of questions I'll ask you and your audience. First off, if you owned a restaurant or even a chain of restaurants, Brian, would you eat at your restaurant?
Hope so.
Yeah, I would hope so, right? It's your business. Okay. If you had a barber shop or a salon, would you get your hair cut and, your nails done and everything else at your salon?
Yeah,
absolutely. I would too. And clearly, like, you guys can't see if you're listening, but I need a haircut pretty bad. So if I had a salon, I would get my hair done at my salon. I wouldn't walk down the street and go to a competitor salon. And if you owned a gym, would you go to your gym to work out?
I would.
Of course. These are sort of your audience is probably thinking, these are so stupid. Of course I would. So let me ask the final question. If you owned your own bank, would you make deposits in your bank?
Yeah.
If you needed to buy a car, would you take a loan from your bank or somebody else's bank?
Yeah, my bank.
Your bank. And if you needed withdrawals or anything else that a bank does, you would go to your bank for these banking functions.
Yeah.
That is the simplest way that I can explain what the infinite banking concept is. It is the act of creating your own banking system and using your bank for your banking functions in your life. And they can be far and wide. Just think of everything you use somebody else's money for: the credit cards, the lines of credit, the car loans, the boat loans, the house loans, the mortgages, the rental loans, all of them. What if, just conceptualize, what if you could be the bank on every one of those purchases, and every one of those monthly payments that today leaves your family forever now had the opportunity to come back into your family, interest and principal? And how wealthy would that family be if they just took that function back? Well, that's different for everybody, but everybody, if you just did a budget and you looked at how much money leaves your family every month, not your expenses, but your debts, how much money leaves your family every single month paying for all of those things we just talked about. And the answer for many of you is a lot. So if all that money came back, this is the simplest way of building wealth. You build wealth through your own debts and expenses that you already have by changing just one thing.
And so, Chris, I, I think a lot of my audience is educated, at least somewhat, on this, because we've talked about this a lot,
Sure.
At least in the past. And if you haven't, you guys are watching this right now and you don't know what we're talking about. Well, Chris really explained, I guess, conceptually what it is, and gave some really good examples of it. But Chris, this is the hang up that I see most people having with it. It's tied to insurance.
Yes.
It's tied to whole life insurance.
It is.
And that is a mental hang up, a mental block for the people that don't buy into it.
Heck yeah, it is.
So
it was a mental block for me, Brian. Man, I was at the time I learned about this, I was a 14-year veteran in the Wall Street world. I was a high-level financial advisor. I knew all about whole life. I had sold whole life, but I didn't particularly like whole life because to me it was an overpriced life insurance policy, and I could do better by selling, a client a term policy and then investing their money in a brokerage account, a mutual fund, or whatever we were selling back in those days. So to me, when I first heard about this, and it was through a very, very wealthy individual named Mike. I was out in Salt Lake City and we were talking real estate because he was a big lender for me. And I remember sitting down at the Cheesecake Factory downtown Salt Lake City. And he says to me, or I say to him, actually, I said, Mike, got to tell me, like, you're always talking about being the bank. And I get it. Like, you're lending money to me from your self-directed IRAs. And you're also like lending from something else. Like, can you explain that? And he said, oh yeah, my private bank. I'm like, yeah, did you go and buy a bank, Mike? He's like, no. This guy helped me set up a bank, and it's just a specially designed and engineered whole life. Instantly, that word hit my brain, and I'm like, whoa, Mike, dude. First off, man, I don't mean to be disrespectful here, Mike, but I'm an advisor, and whole life just doesn't work that way. And he leans into me, Brian, and he says, if whole life doesn't work that way, how have I been lending all this money to you? And I lean back and I say, wow, touche. I said, teach me, Mike. And he says, well, I can't. I'm not the expert. You got to call this guy Brent. And, I call this guy Brent, so excited about this thing because I feel like I was just on the verge of cracking the code to what these wealthy individuals knew that I didn't. And I remember I get Brent on the phone, and Brent says to me, he says, all right, well, great. We can certainly chat, but have you watched the 90-minute video? I said, Brent, man, I'm an advisor. I don't need to watch no 90-minute video telling me what whole life is. I already know. And he says, no. You have to watch 90-minute video. It's a prerequisite to a phone call with me. So when you watch it, let me know and we'll do a call. So I reluctantly went down on a Sunday with a giant cup of coffee to watch this video, and I hit start, and 90 minutes went by like 15 minutes, 4 pages of notes. And I swear on everything holy, I found the answer. I cracked the code in that 90-minute video, and I understood what I should have known my whole life and what I definitely should have known as an advisor. And what I really figured out is it wasn't at all about the whole life. It was about the process, the infinite banking concept, but the whole life wasn't what I thought it was either. See, to me, I think just through time, and many of your audience probably thinks this, but I bet you do, that there's only one whole life. Like, a whole life is the one Dave Ramsey says is the worst place you can put your money. And Susie Orman and so many others tell you it's the worst place you can put your money. And you know what? I agree. If you buy a whole life from the insurance store down the street or from your broke ass brother-in-law, you probably would put your money in a terrible vehicle to hold your wealth. But that would be the same as us being ignorant and saying that, a Ford Focus, that there's only, let's just pick on a car, that there's only one model of a Ford Focus, the one that we walk in and see on the showroom floor of the dealership. But then all of a sudden we're browsing YouTube and we come across this rally video of this guy, Ken Block, going 130 miles an hour sideways in full control in a Ford Focus. And you sit there and you ask yourself, wait, he's driving a Ford Focus, and that Ford Focus and the dealership, they can't be the same cars. Well, they really are. They're both a Ford Focus. But Ken Block's rally car was designed and engineered to do 130 miles an hour sideways in full control. A whole life can be designed and engineered to do a multiple of different things if you know how to do it. I simply, even as an advisor, had no idea how to do it and how to build it. And that's where the disconnect is for so many people. They just think that a whole life's a whole life's a whole life. It isn't. It's designed backwards from what you think of when you think of life insurance.
And that really leads me to this, because I've talked to people when I was first discovering this. I remember going to my insurance guy and I was asking these questions. I'm like, can you do this? And here's the answer I got. He had to, first of all, he had to go ask one of his superiors because he didn't know what I was talking about. And then he came back to me with the answer. He's like, oh, yeah. So you can do it that way, but we're taught not to. We can't sell it that way, though, because, just being honest, first of all, we don't really understand it. Second of all, we don't make any money on it.
Bingo. You nailed it. Why everybody always says, if this is so great, Chris, if this has been around for hundreds of years and all these wealthy families from the Rockefellers, the Rothschilds, all the way up to, today's sitting president, all use this, then why haven't I heard about that? There's something wrong with that, because I should have heard about this. Sure. Go to your advisor and tell them, here's how to build it. Like, learn, you have to get educated. Here's how you build this thing. It's backwards. It's upside down, blah, blah, blah. And your advisor very quickly will realize what's going on. And he will say, ooh, that means I'm going to take a 90% reduction in my compensation to do this. So basically, I'm doing this for you for free. And the conversation ends right there. Oh, well, we can't do that, but we can do something similar and build you an IUL, Index Universal Life, that can do almost the same thing. Now, why would they say that? Is it that IULs are really the greatest thing since the toothpick? Or is it that they pay a really big commission? Folks, I come from the Wall Street world. It's all about commissions. We hunt for commissions. And that's exactly where the problem is. No disrespect to any advisors, I come from that world. I understand you have to eat, you have to put food on the table, but you have to understand that if you're trying to do what we talk about, the infinite banking concept, you are going to have to give before you get. And when I first realized this, I didn't start selling this when I did this. I didn't start teaching this. I was a user. I started using the infinite banking concept. I never even thought about doing this until one day, Brent was out here in my event. I have an event center here. We were doing a RIA and Brent's speaking. And I sat there and I'm like, wow, this is amazing. Why am I not teaching people this? And we went to dinner with Brent that night and he kicks me under the table, or my wife kicks me under the table. And I'm like, what? And she says, Brent, Chris would love to help you spread this message. And she just came, like, she said that. I didn't even know she was going to. I was kind of upset because I'm like, I'm not ready to do that. I'm not ready to speak. This isn't what I want to do. But then I got thinking about it and I just embraced it and I started teaching it. But here's the thing. Why do we do this if it pays so crappy in terms of commissions? Well, we understand the simple law. And I'm writing a book called The Laws of Wealth. And one of the laws, it's the most important one, is law number 5. And I'm just going to read it. Wealth shall find you if your heart and soul are focused on solving other people's problems. In that law, the 5th law of wealth, is exactly why we do what we do. We fully focus on solving other people's problems before our problems ever even come into light. And even though we make so little amount in commissions, we help thousands of people. We're almost at 4,000 clients now, adding 200 a month. So what we found is, even though the commission's small, if we just solve a lot of people's problems, we ourselves have our problems solved, which means we make a lot of money. Too many people are focused on the short term and they want to hit home runs every time. Right. We are literally taking inch miles. Okay. My buddy Kelly calls it that, inch miles. Instead of milestones, we do inch miles, right? Or inch stones, I think is what he says. We're hitting little base hits. But because we hit a lot of base hits, man, we win the game. If you watch Moneyball, that was all about what it was. It's all about hitting base hits. That was it. And that's what we do really well.
You explain this really well, and I appreciate you doing this. Here are kind of the questions I have. I want to dig into the minutia just a little bit. just to give people, I guess, a little bit, more of an understanding for the analytical folks out there, because that's kind of me. You talked about how to build it, how to build the actual
The whole
policy
life.
or concept or whatever it is. So it's very difficult for you to walk in to your guy that you use or gal that you use and just say, here's what I want to do, because it has to be built and structured a certain way. Is that correct?
100%.
So all uh, becoming your own banker, infinite banking concepts, all of these things, all these policies, they can be structured a lot of different ways.
Yeah.
What does it, how do I know that I'm getting the right thing? How do I know that I'm getting what's right for me? Would you, if you were my advisor, Chris, would you look and cater something specific to me, or is it just specific to the industry, the concept?
Brian, this is awesome. Nobody, and all the hundreds, maybe even thousands of interviews I do, nobody's ever asked me this. And it is single-handedly one of the most important things I think that nobody ever asks is there just one pre-built model? No, not even close. Matter of fact, we, as our company Money Multiplier, has broken it down into 4 different quadrants, 4 different plan designs, and we can modify each one. I mean, there could be thousands of designs you could do, but we've got 4. And how do we determine which one is right for our client? Well, when we do our call with our client, the only thing we're doing is asking our client about their situation, their needs, their goals, and what problem are we solving. First off, if somebody's in massive amounts of debt, they're saving a little, but they've got lots of money that leaves their family forever. Well, we already know that their problem is we need to get rid of the debt. We need to take back all the money that they're giving away to everybody else. And I'll do an example of that in a moment, but that would be the problem. So because of that problem, we know what the design is that solves that problem the best. Somebody might come to us and say, hey, my problem is I want to buy a car. And I've got this cash. I was going to go pay cash for the car, but I saw your video or read your book, and there's a better way that I can get all the money back for all these cars that I buy, drive, and own. So there's a design that works best for buying cars. Or maybe somebody's a real estate investor. I work very heavily with real estate investors and professionals like surgeons and doctors, and their needs are different than the other two because they have immediate needs to move their capital. In other words, most real estate investors are experts at moving their money. They save money, they move it in through their deals, and they then move it to another deal and another renovation. Their money's always in motion, which is unbelievable because that's law number 2. Your money has to work for you, and real estate investors are the best. So if that's the case, then we need to design a plan for a real estate investor that gives them access to the most amount of money in the first year. And we can do that. We can accomplish that and get people almost 90 to 95% of their money available immediately, which is unlike any other whole life anyone has ever seen. But we have a design that does that. So you can see, like, it all comes down to what the client tells us their problem is. And then we understand their situation between their income, their debts, and everything else. So we can very quickly, in about a 30-minute phone call, determine what problem are we solving. Now, I want to be very clear. There is no one design that is the silver bullet. There is no one plan design that will solve every problem somebody has. It's exactly why I have 8 of these policies. I don't have one, I have 8 of them, plus 2 on my wife, or I'm sorry, 3 on my wife, 2 on my mom, and 1 on my 18-month-old daughter. Not one of them will ever work for everything. So I have layered my policy designs to solve multiple problems. I have policies that do just cars. I have policies for real estate. I have policies for lending. Real estate and lending are the same design. But that's the long answer to your question. And I think it's a phenomenal question because there is no silver bullet that solves all problems.
What's the 4th one real quick? Debt. I got debt.
Like yeah. So you got debt, car buying, and then like real estate or private lending. And then one would be like the 4th one, which is not really a common one, would be like more long-term goals. Like somebody has money, but they want to save for retirement and they want to tax for retirement, as The Power of Zero, that book talks about with the Lipper. So, or yeah, that's basically, or LERP, not Lipper, LERP. They talk about that, life insurance, retirement planning. So that would be the 4th design. And that one is designed very different. It's designed the same as my daughter's policy is designed. It's not as sexy in the early years, but in the later years, man, that thing is just a fire breathing monster.
So real quick, this isn't my actual question, but real quick, you talked about it being did you say it's built backwards to where and forgive me because I don't know this, you're the
Okay.
expert. It's built backwards in the sense that the death benefit is really low. Is that how it works? Like, what did you mean when you said
Precisely.
earlier that it's built backwards?
Yeah. So, like when you buy life insurance, whether it's term insurance or whole life or any life insurance that you've probably ever bought, you bought a death benefit because that's what life insurance is, right? It's a death benefit that pays out upon your graduation. So, when you are buying life insurance, a lot of people, we got to change their mindset. They'll come to us and they'll say, okay, so what would be a $250,000 policy? To me, when I hear that, I'm like, okay, you want to put $250,000 in premium deposits into the policy. Oh, no, no, no. I mean, I want to buy a $250,000, death benefit. Like if you can just picture a car going 100 and locking the brakes up, that's the sound in my mind that happens. Right off the bat, I will dismiss the call and I will say, please go back and watch my 90-minute video and learn how this works. Because first off, if you think you're buying a policy that is a death benefit, you've got this all wrong. Call your life insurance guy, because we don't do that. We are building a plan that is death benefit is important, but it is absolutely reduced to the lowest levels that the IRS will even allow it. So when someone comes to us, how they come to us is, remember, we're building a banking system. So when you come to us, you say, all right, I want to deposit $1,000 a month into my policy or into my banking policy. Now, all of a sudden, what we do is we take that amount, that goal that the client has, that's their savings amount. And usually the savings amount is determined by however much they're saving now. So we then would go to the insurance company and we'd say, okay, we have a client, this age, this health, that wants to put $1,000 a month away. What is the minimum death benefit that we can put on this policy to support what they call MEC 7 pay rules, which are the IRS rules. So the insurance company will tell us, here's the minimum. But then we go an extra step. And Dave Ramsey should literally send me a thank you card when I say this. We understand that a whole life, the base part of a whole life, is expensive. Like it's an expensive death benefit because it's for your whole life. But term insurance is very inexpensive. Term, it's for a term of time. It's life insurance for a specified period of time. So if the IRS says you need $1.2 million in death benefit to support this premium deposit, which if it's $1,000 a month, it's probably $500,000. That's the minimum. What we're then going to do is we're going to then design that the most efficient way so that the cash value of the policy is the most efficient and grows the fastest. So what we then do is we take that 500,000 and 60% of that 500,000 up to 90% will be term insurance. We'll literally use a 7-year, 1 year renewable term policy for 7 years because it's dirt cheap. And then in the 8th year, we get rid of it. We drop it. It's gone. Like we just cancel the term insurance
Because
and
the
then
death benefit gets higher.
Because once people don't understand this, but when you make these deposits in, even though we're putting very little to the base policy, the majority is going to what they call the paid up additions rider, which is where the cash value is built from. When we build these paid up addition accounts, the death benefit slowly over time increases. As we put 1,000 in every month, the death benefit goes up. Every deposit increases the death benefit. It's a slow growth. So for somebody that's buying death benefit, don't call us. Like that's not what we do. You'd be very upset and your wife would be even more upset at us because the death benefit's going to suck. But in the early years, it's actually going to be pretty good because of a term rider. Exactly what Dave Ramsey tells you to do, because term is cheap. But we don't build these plans for death benefit. We build them for banking, which means for cash, because I've never met anybody in my life that cares more about the money somebody gets the day they die more than they care about the money in their bank today to use. I mean, that's how we build them.
You can put a term rider, so you can almost like make it term insurance for a short period of time until that, and then you drop it, and then it just the death benefit kicks
Correct.
the whole.
Yeah, a lot of our plan, like I just built a big one the other day. It's it's about 900,000 going in and 100,000 a year. And his death benefit, if I'm not mistaken, was $8 million. His base policy was like 1.1. So like you can see the majority of his death benefit is term. And we drop the term as soon as we can by IRS rules, which is in the 8th year. We just gone. So their death benefit falls a lot. So if your wife saw that or your husband saw that and you're like, wait a second, why does the death benefit fall off so much in the 8th year? It's by design. We built this thing backwards.
And this is so that you can increase the amount of money that you can pull out the quickest. Is that why you do that?
No, it's Because it's efficient. So if you think about it, why
Wow.
do we use whole life insurance? And why did the Rockefellers and the Rothschilds not keep their majority of their wealth in banks? They kept it in insurance companies. Well, insurance companies are, number one, the most stable financial institutions there are on earth, hands down, bar none. Number two, insurance companies are in the business of providing guarantees long term, hundreds of years, not 10-year blocks, not 20-year, hundreds of years, because obviously that's the game that they're in. So because of that, they invest for the long term, different than any bank or any Wall Street firm can ever invest. Insurance companies play the long game, and they have been for hundreds and hundreds of years. So the return, we call it the perpetual tailwind that insurance companies make on their surplus money. And for the record, insurance companies have all the money. Banks don't have their own money. They have your money. Insurance companies have their own money. So therefore, they invest their money very conservatively with a long-term approach, and they make really consistent returns. And because all the insurance companies we deal with are mutually owned, not publicly traded, we can benefit in that insurance company's returns by participating. That's what it's really called. And we get dividends. So because of the guarantees that the insurance company can pay right now up to, and this is different than it was before, it just changed, 375, so 3.75% guaranteed for the rest of your life. Plus, then we get to participate in their gains through a dividend, which any unused premiums the insurance company took in, they just return it back to its policyholders in the form of a dividend. So by today's numbers, we are making 6% in 2021. And in 2022, it'll be the same. So I don't know about any of you, but does your bank pay you 6% on your money? But see, the other thing too, the reason people use bank accounts is we've been taught to go trade hours for dollars. We make money. I'm holding $100. And then what do? We go put it in somebody else's bank. And the bank makes 400 to 1,300% more than you do. And then the reason you use a bank is, oh, well, if I need that money, I can go back and take that money out. And the reason people usually think negatively about whole life is they think if I take that same $100 and I put it into this whole life, I can't take that money out. Because all whole lives that anyone's ever seen, just going the traditional route, there's no money in the first year, there's no money in the second year, and there's barely any money in the third year. So you literally just locked your money up for 3 years. But the plans we do, if I put 100 in, okay, and just doing this as an example, you'd never be able to do it with $100. But if I put 100 in and I need that money back immediately in the first 30 days, I then can take up to, let's just use $90, because it's never going to be 100% in the first year. First year is your worst year. But if I put 100 in, I then can take out $90. But pay attention closely, because this is the magic, and this is the number one reason why we use whole life. When I take the $90 out, let me just grab another, just pretend this is $90. Okay. I put 100 in, and in the first 30 days, I took 90 out because I have a place for this $90 to go. I'm going to pay off a debt. I'm going to pay off Visa. So that $90 that I'm holding, is that my money? Well, most people would think, well, yeah, I put 100 in and you took 90 out. Of course it's your money. Wrong. It's not my money. The insurance company actually gave me a loan of $90. And this is where people are like, oh, I knew there was a catch. It's a loan. Like I'm trying to get out of debt, not get in debt. Well, what if I told you the $90 loan never needs to be repaid? Because the loan that the insurance company gave you was an advance of your death benefit that they promised to pay your beneficiaries the day you graduate. Nice way of saying die. So the $90 is the insurance company's money given to me in the form of a loan, because loans are tax free. Why? Because they have to be paid back. But do I have to pay this back? Nope. Because if I just don't pay it back, when I graduate, the insurance company is going to true up. They're going to say, okay, we gave this guy a $500,000 death benefit. He took $90 out. We're going to take 500,000 minus 90. We're good. And they pay the difference to your beneficiaries. You see, it's all the same to the insurance company. They play the long game. So if I put 100 in and my 100 was by today's standards earning 6% with dividend, and I take $90 out, I still have $100 earning 6% uninterrupted. That means now I'm tapping into what Albert Einstein called the eighth wonder of the world, compound interest. My money gets to earn interest for the rest of my life without ever being interrupted. And it just compounds on itself over time. One after, day. It's boring, slow grow.
That's the magic to this.
That is absolutely the only reason we use a whole life. And if anybody can come to me with a vehicle that does a better job than whole life, I promise you, on everything that I have to promise on, I will change every training and every presentation. But you know what? For hundreds of years, there isn't anything that can do what a whole life does, and there never will be. So good
Chris,
luck.
Explain that one more time about how you can take money, you put money into a policy, you can borrow from the policy, as if the money never left. That money that you took out, the original $100 is still earning interest, even though you
Okay.
took 90 out.
Let me explain it in a different way. This is right out of Nelson Nash's stuff, a parable, right? If you had a house and your house had equity and you wanted to tap into there you go, becoming your own banker, the Godfather right there. Yeah. But if you had a house and you had equity in your house and you wanted to tap into that equity, there's two ways you can do it. You can sell the house and get the equity out of the house, but then you no longer have the asset. Or you could keep the house and get a line of credit with a bank, and the bank would give you a line of credit, giving you access to that equity available. But the equity is basically just collateralized by the house and the value in the house, right? So the house doesn't get interrupted. It's just you're collateralizing it by the equity. Think of it that way. When you take this loan from the insurance company is giving you part of your death benefit. Okay, so that's why the loan is not repay. You don't have to repay it, even though we teach people to. You don't have to. Secondarily, your money never actually did leave your account. You made it a premium deposit into your account, whatever dollar amount, 100 or 100,000 or $1 million, that 100,000 or million is still in your account, even if you took all of it out. Okay. Let's say you put 100 grand in, you take 100 grand out. You still have 100 grand earning 6% because when you took the 100 out, it wasn't your money. The insurance company in their giant surplus gave you part of your death benefit that they're going to have to pay someday anyway. So now I've got this money to use to invest and go make more money, but I never stopped the interest that my money originally would have earned. But you can't do that at a bank. In the insurance company, never, nowhere. Well, actually, there's one place. Like if you were very wealthy and you had a big brokerage account, you could go in and you could get a line of credit or a margin account against your brokerage account, and you could access and use their money, the house's money, if you will, the bank's money, and then it's collateralized against your brokerage account. So that's similar, but that's risky because your market value goes up. This is a guaranteed way of looking at this, right? There's no risk to the guaranteed interest rate that you're making. But here's the downside. And everybody would catch me very quick if they know this. They would be like, oh, you're leaving out an important part, Chris. No, actually, I was saving it till now because this is where everybody thinks that this is a problem. And I think this is the greatest thing ever. That money that the insurance company gives me, that $90 loan in this example, they're going to charge me interest on that money. Darn right. They're going to charge me 5%. Well, actually, it's a little less today. It's about, I think, 4.75 today. But let's just round it up to 5, okay, for all intents and purposes. They are going to charge me 5% on that $90 loan. Oh, I knew that was a problem. That sucks. Wait a second. So if your money that's sitting in your policy is earning 6%, and when you take it out, they charge you 5%. What is your spread? Let's just say the gross spread is 1%. Is your bank paying you 1% on the money that you have to leave in there? They're not. Is your money market or your CD even paying you 1% on money that you have to leave there and not be in control of? No. So you literally make a spread that is bigger than anything you can make in any other channel today. But yet the best part is I now got the money. I can then go out there and I can take this $90 and I can invest it, or I can pay off Visa. And if I was paying Visa 20%, if I pay Visa off, the $90 pays Visa off in this example, and I paid Visa $10 every single month. Now I don't owe Visa $10 every month. See, what the smart people would do, what the wealthy would do, is they would treat their money the same as they treated Visa's money. They were used to paying Visa $10 at the rate of 20% interest. So if I pay Visa off with my bank, well, I got to treat my bank's money the same as I treated Visa's bank's money. So I take and I just change one thing on that check. Instead of writing the name Visa in the line, I write Chris Naugle's policy. I mean, I write the insurance company, but just pretend it's you writing your name in it. And then every month I set up a bill pay for $10. That $10 comes back and goes right back in my policy as a loan repayment.
Because you don't want to steal the peas, Chris.
Thank you. Right out of Nelson's book. If you owned a grocery store, you wouldn't go in and steal peas every day. You'd go out of business. Well, if you owned a bank, you wouldn't steal from your bank either. Exactly. But you see, a lot of people have a problem with this. They're like, wait, if I saved up enough money to pay cash for a car, why would I ever make a monthly car payment back to my bank? I have a very hard time with that. I have a hard time because I just don't understand where people even logically think that doesn't make sense. So if you saved up enough money in your banking policy to buy a car, I just bought a Maserati yesterday, right? So I saved up enough in my policy, took a loan from my policy, and I paid cash for a Maserati. But before I just said game over, like most people would, because if I just did that and I just paid cash for that car, that money would never, ever be able to work for me again. And that's not okay with me. So what I did is I went to the dealership and I said, Brian is the guy's name that owns the dealership. I said, Brian, if I were to finance this Maserati over 5 years, what would my monthly payment be? I wasn't ready for the next one. He's like $1,768 at these low interest rates. I said, perfect. What's the rate? 3.04%. Okay. So now I've got my equation. I take the money from my bank. I buy the Maserati. I then set up a bill pay for 1,700 and change every month. And that 1,700 and change goes back into my bank. It's the same exact amount I would have paid to M&T Bank or any other bank that would have financed the car, except for now I used my bank's money. So I pay myself back principal and interest. Like, here's the equation of what happens. People are like, why would I ever do that? I have the money. Why would I pay interest on my money? Because you keep it all. Because all the money goes back into the same place it came from, which is your bank, which you're in control of, which you can use the next day. Why does that not make sense? It's the most logical explanation for buying anything, because it's a circle. Your money starts on the left side of the circle, goes over to the right, which is where the opportunity is, or the things you buy, cars, boats, investments. Okay. Then when you buy those things, then just take the money that you normally would have given away to somebody else, or the money you would have made and given to somebody else's bank, and move it back to the bottom part of the circle into your bank. It's just a circle, folks. It's so simple. But the cool part is, when you do this, you control every penny of your money. You have no leakage. Your boat never has a hole in it, because all the money comes back to the same place, and that is your bank's account.
Real quick, I've got two. I want to respect your time. I got two really big questions I want to ask you before we leave. I want to draw attention to the book I just held up. It's called Becoming Your Own Banker by Nelson Nash. He's passed away now. He wrote this book. He was from Birmingham, and I got a chance to meet him and interview him. I'm going to actually put that in the description, the interview I did with him, and Chris's talk when he came to Birmingham. I'm going to put that in the description as well, guys. So check those out. Get this book. Everything that Chris is talking about right now comes from this book, Becoming Your Own Banker. And he's also written some books of his own. And we're going to talk about those in a second, Chris. But before we do, here are the questions I have. And we're running out of time, so I want to try to be efficient with this. You said that there are 4 different ways that you design these policies. I want to draw attention to 2 of these. Number 1, the one that you spoke about for real estate investors, specifically moving money around. What is it that you do specifically with that policy? Because if anybody else is like me out there, you kind of hit the nail on the head there when you said earlier that I'm like an expert at moving money around, because that's all I do. I feel like I'm doing that every day. I'm moving money around. A, is that a bad thing when I have a policy like this? How does that work? And B, what are you doing differently with this design that you're not doing with others? What makes it work?
Yeah. So no, it's not a bad thing at all. And for someone like you or anyone else that knows how to move their money and keep their money, making money out there doing something, then that would be really the best solution for you. Because if you have more money to use, and usually it's about 20% more right out of the hole, 10 to 20% more of your money is available immediately. If you had 10 to 20% more to move, then you have 10 to 20% more to make money on out there. So even though these plans that we design for high early cash value, they lack in the later years, like in years 15 on, they wouldn't beat the other ones that I was talking about that have less money up front. However, because your money's moving and you're making it work, the money your money makes, okay? Because when you move your money and you make your money work for you, your money's out there producing offsprings. It's called interest or gains or dividends. Those offsprings then equal a whole lot more money. So if you can move your money, that's the only design you should do, is the high early cash value. Even though you make a little less in the long run, it doesn't matter, because you made so much more making your money work for you in the short run that it will outperform anything you'd ever have given up in the long term. Now, and I'll explain how that design is done in a second. But for somebody that didn't know how to move their money and just wanted to put their money in and maybe buy a car every 5 years, this wouldn't be the design, because they'd be better off doing the longer term one, have a little less available in the early years. Instead of 90, maybe they have 60 to 75% available. But now, because they're not moving it like me and you would, they're only using it sporadically. They're going to have more money in the long run, because the plan is more efficient in the later years. Think of it like a rocket ship. A rocket ship blasts off. Okay. It's got big booster rockets around the bottom of it. But when it gets in orbit and it's there, it doesn't need those boosters. It sheds them. They fall back to Earth. Today, they land them on barges, but then it just uses its main thruster rocket. which is the most efficient one, fuel efficient and efficient for getting them where they got to go. Policies are the same way. The booster rockets are what we put more money into on these high early cash value plans. But later in the years, when we drop the booster rockets, which we will usually after year 10, the plan is going to be less efficient in the later years because now we've got a smaller main rocket. Okay.
Because
the boosters have fallen off.
Because you've designed it in such a way where I'm getting access to more money quicker.
Absolutely. Yeah. And you know, we can get up to 95% in these.
So let's give a real scenario here. Let's say I'm a real estate investor and I'm going to, and maybe I'm lending. Let's say I'm private lending. I'm going to put money in my own bank and I'm going to start taking it out as quick as I can, make a loan. Because when the money, and this is really actually my second question, but I'll just wrap it all up into one. The question I probably get most often is, Chris, we save to invest. Okay. I don't want a bunch of money sitting in a bank. I don't care if I own the bank or I don't own the bank. I don't want a bunch of money sitting in a bank. Okay? That's the number one question I get with this stuff. But what I hear you saying is, well, we put money in our bank and then we withdraw the money out of our bank and we go invest it in what we were going to invest in and take those returns and put it back in the bank.
Right. It's the same thing you're already doing today, except for this bank. That one change is where your money goes first. This bank pays you a much better return. And when you take the money out of this bank, which is this whole life, your money never stops earning interest. That's the sole reason you use this. But you're right. Like, you know, the biggest complaint that we used to hear is people are like, yeah, but if I only have access to 60 or 70%, like the old designs that we used to do, because the newer ones, we can get much higher, but the old ones, and they're like, I don't know. It just doesn't make sense to have, 20 or 30% sitting there doing nothing while I'm only using 70, percent of my money. So we've just, changed the design, worked with the insurance companies, and the insurance companies have evolved and created better products in the whole life realm for corporate use. And now those corporate policies called COLI or BOLI in the bank world are now able to be used by us. And all these policies are designed to do is give more cash value. Think of Samsung. Samsung uses this. They put money into this, and then they go out and they buy their goods and services to make their phones and everything else. And then they owe that money to those vendors in 30, 40, 60 days. So instead of putting money in a bank account and paying their vendors in 30, 40, 60 days, they put their money in this policy, and then they take the money out of the policy and they pay the vendors. Okay. So it's the same equation, but now their money always earns interest, never stops. Right. But those policies obviously would have to have a much higher access to capital in the early years. And they do. They're called HECVs or high early cash value plans. And they give 90 to 95% if designed properly. Now, to get to those levels, you got to understand, like, don't come to us and say, hey, I want to put $500 a month in and I want one of those 95% plans. It's not going to happen. To get to those levels, we got to front load the plan. So we got to say, I'll just give an example. Let's say somebody's got 50 grand sitting in their bank that they're going to do a private loan. We would change where that 50 grand went. We would dump that into the insurance company's general account through that rider. So 50 grand gets dumped in, but then the person says, okay, well then after the 50 grand, I want to deposit 1,000 a month. Great. That 50 grand, think about it. That's your engine. You just put that money in and that just supercharged your whole machine because now you got 50 grand earning interest and dividends immediately that supercharges the rest. Instead of waiting for $1,000 to capitalize and build, that's how it works.
How or why would a wealthy person use this? Like say I've got $1 million sitting in a bank.
Mm-hmm. Well, I mean, every wealthy person I've ever met, and wealthy can be defined in different categories, but let's just say somebody that's got 5 million or more. Okay. We'll just call that, and that's more rich than wealthy, but 5 million or more. Like the first thing that they already understand are some of these laws of wealth. They understand that they've got to move their money and make their money work for them. So they already have places that they're investing. They have things they're investing in. So the only thing we're really changing is not what they're investing in. We don't care what they're investing. We're changing where the money goes first. So for any wealthy person, they understand mathematics and they say, okay, well, if I put my money over here and it makes 6, and I use it, it takes, 5 of that 6 that I'm making back, I make a spread. But you see, they also understand compound interest, and most people don't. They're like, most people that hear that, they're not excited about 1%, nor should you be. But you see, it's 1% the first year, the second year is more, the third year is more. By the 5th year, it's probably 10% because every year your money is compounding uninterrupted. So therefore, year 1, let's just say it's 10 grand, that 10 grand earns 6%. So the next year it's 10 grand plus 6% earning that same 6% and on and on. So compounding is something that's very powerful. They understand this. All wealthy people do. So if every year that goes by, that spread that we just talked about gets bigger and bigger and bigger. And it doesn't involve that wealthy individual to work any harder, any longer, or take on any additional risk. It's just mathematics working in their favor, which is why Albert Einstein said, those that understand compound interest earn it. Those that don't pay it. What's the difference? And why do wealthy do this? They understand compound interest, so they earn it. And they don't want to pay it.
You've said this so many times, and I just want to reiterate it. It's all about what you do with your money first. It's all about here. The only thing that's changing here is that where your money is going first. And this is what I want you, last thing I want you to touch on, Chris, is I'm not going to get access to all my money right off the bat.
Nope.
And I think that's one of the bigger downsides and bigger questions I get as well. I put, $1,000 in a month, $10,000 in a month, whatever it is, whatever you want to do. I don't have access to all that right away. It usually takes depends on how you set it up, but it takes until year 3 or 4 or 5 or so before I have access to all my money.
I love this. And you notice the shit-eating grin on my face as you were saying that. So here's the people that this doesn't work for. Here's the people that say that this is a scam because of what you just said. So there are, I guess, a few people out there that would say, I'm not going to do this because if I put in let's just use 10 grand, right? I put in 10 grand into this policy, I can only use $9,000, and that's just not acceptable. Great. Don't do this, because you are one of the few that goes to your local bank, puts 10 grand in your bank, and before the end of the year, just to prove the point, you go back to the bank and you take all $10,000 out just to say, see, told you I could do it. Your policy can't do that. How many people do you actually know that put money in their bank or their savings or any account where they save money, and then they take all of that money out every single year?
The only people I know who do that are real estate investors who need access to that money, and
Correct.
they're trying to go and put it somewhere to invest it. And I think that's where I hear this the most.
I don't think they take all of it out though, but let's just assume that they do. Yes, that's a hurdle you have to understand.
I think what's happening though, Chris, is folks see this as, here's the money I have to invest, so I'm going to put it in my own bank.
Yep.
Versus, here's all my money that I want to take and put in my bank. They're talking strictly about the money that they want to invest. Well, if I put it in my own bank, I can't get it all to go invest it.
Yep. In the first year, correct. Usually most of these high early cash value plans with the dump in are going to have all the money available the second year, or at worst case, the third year. So you're right. I mean, if somebody actually is so good at moving their money that they literally put money in their wherever account they're holding it, and they use every penny of it every year, and that's like a hang up that they're not willing to give up, this isn't a good fit for them, because this is going to, building wealth. And I'll say this, and I say it a million times, building wealth is a marathon. It is not a sprint. Sure. If you are sprinting to build wealth, I promise you wholeheartedly, and I am right, you are wrong, your money will flee you. You will lose all your money. I promise you, because you're trying to sprint to something that every wealthy person understands is a marathon. So if you're that sprinter, don't do this. This won't work for you. But if you're the person that understands that you want to build long-term wealth, and you want to keep your money and be in control of your money, and you want your money to grow in a tax-free environment, which we didn't talk about, this is the greatest thing since sliced bread for those people. But yes, you have to give to get. That's the story of life. You're going to give up a little in the first couple of years, a little access, to then get an amount that I can't even explain to you that would even have you say anything other than that sounds too good to be true. So if you're not willing to give up for the first couple of years and then make for the rest of your life, this should never even come into a question of whether you should do this or not. You should absolutely avoid this at all costs.
And just to wrap it up, and you can explain this better, but I've heard that the be your own banker concept is the only thing out there where it's the money is liquid, which means you can get it out pretty much immediately. You mentioned real quick that it's tax-free.
That is.
And it's debtors can't come get it.
Nope.
It's what do you call that proof?
Protected against judgments and liens in most states.
Judgment proof. And it's all these different things. And nothing.
And it provides a legacy. I mean, the last law of wealth is, be willing to share and pass on your knowledge. So,
and it's earning interest. It's earning compound interest. It's
uninterrupted.
It's uninterrupted. It's all these things. And there's no other investment vehicle out there like this.
Yeah. And the best part is, when you talk about investments, this is not an investment. Investments involve risk. This is guaranteed. So you can't even classify this as an investment. So yeah, there is no other vehicle on earth, I promise you, that can do what a specially designed and engineered whole life can do while applying the infinite banking concept to this machine.
Guys, if you have questions for Chris, I know so many people who do this, and I'm great friends with a lot of people who do this, and they do it well.
Mhm.
But I've never met someone who can explain it the way Chris does, where I just get it. He came to Birmingham and he gave me this book, gave out this book to our folks. Is this still I know you've written other books. Where can people get your resources and how can people get a hold of you?
Yeah. So, I mean, I live under the one thing that, you have to give, and I give a lot. So all my books are free. You just got to pay the shipping. So if you want Private Money Guide, my first book I ever wrote, go to chrisnaugle.com and you'll see there's a section in it that says free books. But this book here, Mapping Out the Millionaire Mystery, is our newest one. It's all about the infinite banking concept. It's a kind of a modern day version of Nelson's book. So you can get that book for free on chrisnaugle.com, or you could just register for our free webinars and get this little guide that I just wrote. And this guide is, I think it's awesome. It's 68 pages of big type and lots of pictures, teaching you how to get all the money back for all the cars you ever buy, drive, and own. It will take you 1 hour to read this, and you can understand how to get all the money back for every car you buy, drive, and own. This is free as well. We'll send you the ebook. So all of them, chrisnaugle.com.
Chris, and for folks that just are like, okay, I get it, Chris, I get it, I understand it. I want to just get in touch directly with you. Is there something where they can consult with you or consult with your team?
Absolutely. So it's the same rules that I had to go through back when I learned this. First thing, you'll go to chrisnaugle.com. A little pop-up will come up to watch a 90-minute video. I don't care how much you know about this. You have to watch the 90-minute video. And once you do, after you finish, it will allow you to book a call with myself or my team, and we can answer all your questions. And we will not try to sell you anything. I promise you. You will literally have to ask us to help you if you're ready to take that next step. It's just the way we do it. If we teach you, then you should ask us to help you. And that's the way we kind of go about this.
Chris, I appreciate you, my friend. You are crushing it out there. You're making a huge difference in a lot of people's lives. I see it from afar, and it's an honor to know you. And thank you for taking the time.
Oh, man. Thank you so much. It means a lot.
Guys, go to chrisnaugle.com right now. I'm going to put that link in the description. We love you so much. Hit subscribe, like our videos. We love you. We'll see you next time.